We've just had two very interesting processes within our lives at Investec Wealth and Investment. One was the Global Investment Strategy Group, which meets quarterly. The other was the Asset Allocation Committee meeting. We'll get to that in a bit as well, but maybe you could just tell us a little bit of what the Global Investment Strategy Group does.
Yeah, I think the main job of the Global Investment Strategy Group is to coordinate the risk-on, risk-off view of wealth and investment. And essentially what I mean by that is how much risk are we prepared to assume. The other thing that is important for GISG is to identify and validate key investment themes, and then risk and the threats out there.
And I think from a wealth management perspective, what it actually means for our clients is that we've got a global team of professionals, consisting of people from the UK, from South Africa, from Hong Kong, Mauritius, all feeding into the Global Investment Strategy Group, and then they feed back to all the wealth managers and investment managers nationally each quarter, and we can take that information and impart it to our clients so they really get a true global perspective.
Paul, let's go into a bit more detail. The global economy is now in a phase of what we would call synchronised growth. However, the GISG has decided to take a slightly underweight position. Can you maybe talk us through that?
We are in an environment at the moment of synchronised global economic growth, and certainly we haven't been in that environment for many, many years, and that's probably persisted for the last 18 months. You've got your three major growth engines in the form of the US, the Eurozone, and China, all pulling together against a backdrop of, I suppose, what you could continue to call accommodative monetary policy or continuing cheap money. In that aspect. And China, for example, that was a headwind in 2016, and one of our big risks is now actually become a tailwind, and we've actually started to see growth surprising on the upside in China, metal prices starting to pick up, and I suppose on the back of that, as you've seen in the last 12 to 18 months, emerging markets coming back into favour as well. And if you couple that with the normalization of interest rate policy in the US, which up to now hasn't actually impacted on risk asset prices like equity. And I think the reasons for that are, one, they've been, I think, pretty well telegraphed up to now. But two, importantly, I think they've been accompanied by growth as opposed to inflation. In fact, for us, I think the surprising thing that is that inflation up to now has been relatively muted up to this particular point in time. And then you've had double-digit earnings growth as well in 2017, and for the first time in about 4 years, you've seen positive earnings revisions in terms of that earnings growth as well. And we would certainly look for double-digit earnings growth in dollars on a global basis into 2018 and into 2019 as well. And then valuations, which whilst we don't think markets are cheap at the moment, we think they probably appear reasonable under the scenario. And this is the sort of like Goldilocks scenario that you might have heard out there, a little bit of a buzzword. And the Goldilocks scenario is essentially accelerating growth, low interest rates, and low inflation. So all of that sounds very, very positive. So why have we become more defensive? Well, I think the reasons for that are two or threefold. Certainly up to now, I think the magnitude of returns, and the certainty of returns as we go into 2018, I think they're falling at this particular point in time. I think tactically we're probably due a market correction. Certainly we've been in probably one of the longest bull market runs, second longest in history, Ali, and I think in all likelihood probably going to become the longest in history. And I think, there are still risks out there as well. Certainly the normalization of monetary policy, possibly inflation surprising on the upside, are all big risks as well. And we probably just thought it was wise, given that we believe the economic cycle is going to peak probably in 2019, and that markets will probably start to anticipate that during the course of this year. So we just thought we would adjust it slightly and become a little bit more defensive in the current environment, and we've gone slightly risk off at this point in time.
Yeah, that doesn't mean we completely reduce our clients' equities exposure, but it's a slight tweaking to not being as positive that they normally would be over the long term.